Well, I think that short term, you could see liquidations that are survival driven. In other words, survival driven selling that can trigger volatility and sell offs. These are because the big shorts right now. So there's something called a lease rate in London, and that lease rate is normally like 0.5% to 1%, meaning I'm going to naked short something and I need to lease metal to pay it back, or lease metal to naked short it to begin with. That lease rate is normally 1 or 2%. It's now 100% annualized. There is no metal to be leased. The liquidity has been sucked out of the system. The banks don't want to lease the metal. You're going to get people that are screwed and are going to have to margin call. Medium term, once that forced selling ends, which I suspect should be very soon, that's when the fiscal scarcity dominates the marketplace. This is when you see a sustained price well above 50. But long term, this is all about the paper price, the confidence in the paper price collapsing. This is when you see a structural reset in the price of silver as it moves towards 75 or 100. With new settlement hubs, as I might mention, as we've talked about, in Shanghai, in Dubai, in India, in the Belt Road Initiative, and all of these exchanges that the Shanghai Metals Exchange is building. So we are entering a new reality as far as I'm concerned in gold and in silver. Look, let's not forget about gold. It's on pace for its strongest year ever. It's up 60%. Silver, on the other hand, is approaching 80% for the year.
Yeah.
Gold is up for 9 straight weeks, brother. 9 straight weeks, and here we are at $4,200. We've been seeing dealers around the country run out of product, or at least the ability to sell anything, until they get a better grasp on what's going on. There's rumors that the Perth Mint has shut down taking new orders right now. This is what,
Did you discuss with Mark about all the backwardation? I think that's a big part of it.
Yeah. Do you know what backwardation is, Mark?
No, enlighten me.
Okay, well that's really the big deal, is that backwardation is something that is very, very, very rare in silver, and it's very rare in anything for that matter. Normal markets work on what's called contango, and then contango is where the futures price is ahead of, in terms of price, and ahead of the spot price. Think of it, me loaning you some money. If I loan you money and you say, Andy, can I borrow $500? I'm going to pay you back tomorrow morning. Sure, Mark. There's not going to be any interest that I'm going to charge you. If you say, Andy, can I borrow $500 and I'll pay you back in 18 months? I might say, okay, but for the loss of the use of that money, I'm going to charge you at 5% interest annually. So you're going to end up paying me back $575 in 18 months. That's contango. Backwardation says, I'll tell you what, I know that if I were to pay you in 18 months, it would be $575, but I'm going to pay you $595 today because I just want it right now. In other words, when you talk about backwardation, it's where the futures price is less than the current spot price. It's very, very, very rare. We've seen it as high as $2.50 to $3 an ounce over the last few weeks. What it means is there's tremendous strain and stress in the physical market, that the players who need their metal, they want it right now. They don't want the paper promises. They do not want to roll forward their contracts.
And they're paying up for it.
And I'll give you an example how that affects this industry and why it affects people where companies aren't able to deliver right now. So let's say one of your listeners called me and said, Andy, I need to sell 10,000 silver maple leafs. Sure, I'd say, Johnny, I'm going to buy those 10,000 silver maple leafs from you here's spot price. Spot price is $52 an ounce. But the futures price right now is just under 51. So in order for me to hedge my exposure, which I always do to inventory, where I will take the opposite side of the transaction to protect myself. In other words, if I have 10,000 ounces in the warehouse and I have 10,000 ounces on paper that I sold short, if my warehouse drops by $10, I'm out 100 grand. But what I sold short goes up by the same amount, so I'm market neutral. But if the futures price is 5, 8, 10% back of the real price, how do I hedge my exposure with futures contracts that are not matching up with the spot price? It's creating a lot of strain and a lot of stress in the marketplace. And the implication really is that the delivery of physical metal is far, far more relevant to the big players right now than it is accepting the promises of the exchange in a paper form. The physical delivery stress of almost 17 million ounces already been delivered in the month of October alone. Just in a half a month, we've seen 17 million ounces delivered on COMEX, and London spot silver has been as much as a $3 premium to New York futures. This hasn't been seen, if ever, maybe once for a moment in 1980.
I don't think, but to the extent where there was such a big, basically it's between the bid and the ask. Right, but if you also remember, it also took a big fall. The hold at the $50 level was very, very short-lived. The question most people are asking now is spot going? Is the futures market going to get up to the spot price, or will the spot price retreat back to the futures price? I would tell you, certainly based on what we're seeing here, I would imagine that the futures price has to come up to the spot price. Should we be buying more? Suzanne Powers, should we be buying more silver or gold? I think still right now with the silver gold ratio, I think silver is the better bet. I think we buy silver with, of course, the long-term philosophy that when the ratio normalizes to around what we believe should be the start, call it around 45 on the GSR, then we start peeling off the layers of the onion and swapping it for gold. I think silver is definitely the better bet. The question is, and the difficult time now, is actually getting your hands on silver. Mark, if you listen to any of the major guys out there or girls out there, I think that...
Good for you being politically correct.
I'm always politically correct. Not always. But I think that we will probably be seeing in the next, I don't know, a couple of weeks, we'll probably see it. But I think that we've built new support levels. 30 was the last one that we saw. We ripped through 40. And I think that 50 will become our new support level. And I truly think that the next level that we'll be seeing some maybe hesitation, real resistance is probably 80. But as Andy would tell you, just based on that cup and handle formation, 96 is probably the number that I'm going to be looking at. So gold is sitting right now on the futures market. Gold's sitting at 42.10. Here's a perfect example of what the backwardation is, Mark. Silver futures are at 51.43, but the spot market on silver right now is just a hair under 52.90. So
yeah,
we're
52.83 on the Miles Franklin site.
Yeah, so we're still, about a good $1.50 away in between that bid ask and that spread between the futures and the spot market. So it's narrowing a little bit because 2 days ago we were at about 2.5. Now we're at 1.5, but we're not close to where we should be. Usually it's about maybe a 20, 30, 40 cent differential between the futures and the spot.
Someone said they heard me predict 96. I do. That would be the tactical spot. We're just beginning. We truly are just beginning. I believe that in my soul. We are watching the great debasement trade. The dollar is being debased right out from underneath us. And I've said this on your show before, and I will stick to it. Gold and silver will go higher than any of you think possible. That is not why you buy it. You buy it because the dollar is dying right out from underneath us. It is the only way that you can bring back manufacturing is to give up on the reserve status and sell your manufacturing into the massively devalued dollar. That is the premise of the Mar-a-Lago Accord. Stephen Mirren, he says, say nice things. Of course we say nice things about you, Mike.
Orchie's the best.
So the Mar-a-Lago Accord, and Stephen Mirren, who is the architect of that, has filled the vacated spot there. And Judy Shelton was on my show again. This time Michelle McCory interviewed her, and she said again, it's gaining traction. They're going to peg the back end of the Treasury market to gold. They will do that so that on the 5, 10, 20, 30, and ultimately 50-year Treasury redeemable in gold, they can bring back manufacturing at zero upfront borrowing costs. Now, the interesting thing is, you want to talk about putting the dots together. You know who Bo Hines is? Was the crypto czar for Trump until August. Now he's the president of USA Tether. Every single dollar transaction that we all make in the next several months and indefinitely forward will be backed by USA Tether. That that money will all go into U.S. Treasuries. The difference in the interest from the Treasuries to what we get, we don't get any money on those. We don't make any yield on those stable coins. It'll look like dollar bills to us on our bank accounts, but it transacts through stable coins like that, like Venmo or Zelle, instead of the time it takes to clear a check or a wire. But the interest that USA Tether gets on the Treasuries, backing all of the stable coins, every dollar you spend will travel this way. They will buy more Treasuries to push down interest rates, and they'll buy gold and Bitcoin. And the act of buying more gold, they already have $8 billion in gold in Switzerland in a vault. They were just at the Beaver Creek Mining Summit, buying directly from the miners. The act of buying more gold devalues the dollar further. The act of buying more Bitcoin devalues the dollar further. The act of backing it with Treasuries decreases interest rates. They are going to try and make the dollar worth toilet paper in order to sell our manufacturing to the rest of the world and grow our way out of this problem. And you do that by revaluing gold, let it get to $6,000, $7,000, $8,000, and then revalue it much higher. But until that happens, saving in dollars is the fastest way to go broke. And as far as silver and platinum, the U.S. government has classified them critical minerals. There's not anything more you need to know. Oh, look, investing.com, gold has topped $4,200.
So one of your listeners, Coyote Boy Mark, asks, Andy and Kevin, would you recommend selling gold and buying silver with the proceeds? I mean, I think that it's a great idea, but just keep in mind that when you do sell gold, it will trigger a taxable event.
Unless it's in an IRA.
Correct.